Hey, what's going on, guys? This is Alex Cook. What I'm going to talk about in this video is I'm going to talk about the Bumble IPO, and I'm going to talk about actually how it relates to decentralized finance. I've been talking a lot about blockchain, been talking a lot about cryptocurrencies, so I'm going to talk about how this actually relates to DeFi and why I think companies are going to start looking toward DeFi solutions. So, what happened with Bumble? All right, so they IPO'd, gapped up to 70s, stopped trading at around 75 on Friday when the market closed for the week, but the IPO original price was 43. All right, so let's talk through this a little bit. Money was left on the table. Okay, so this happens a lot when it comes to IPOs, and it's just sort of accepted as normal. But I mean, just do the math. Like some of these initial investors, they could have had almost an 80% higher price for their stock than what they received. So let's talk a little about how IPOs work. So what happens in an IPO when a company goes public is the original owners of the company, all right, they want to raise capital to grow their business, or maybe they just want to sell some of their ownership to cash out. So you see this a lot with venture capital, like people that invest in startups, when they want to cash out and move on to the next startup to fund or whatever, take the money to do whatever they want with it. So what happens is they reach out to an investment bank to take the company public. So now the stock, the ownership of the company, it's not owned privately by, let's say the founder or the original, venture capital fund that took a 20% stake, 30% stake, whatever, to give the founder cash. This stock is now owned by the investment bank, who they will then flip it onto the market, onto an exchange for it to be traded publicly. Okay, so what this also happens, or what also happens from this is it gives the owners some price discovery. So they know how much their stock is actually worth because now it's trading on exchange. So you have real-time price discovery, meaning it's trading, just really every second. So they know exactly how much their stock is worth. So how this process works, it gets a little technical, but this is going to be a very simple explanation for it, just for the sake of YouTube. So I'm going to oversimplify. But the owners reach out to an investment bank, okay? The investment bank is going to then purchase the stock from the owners. Okay, we call that process underwriting. All right, and then so the owners, instead of owning stock, they now have just cold hard cash. So maybe they sold all of it. If it's a venture capital fund trying to get out, if it's an owner like an original founder, like the CEO of Bumble, maybe she just sold a portion of it to get that price discovery to know how much in real time is her stock worth, or maybe just a little bit to raise more cash for the business or whatever, money for whatever she wants for her lifestyle, whatever. So they sell a portion of their ownership to the investment bank. The investment bank then gives them cold hard cash, that is underwriting, and now it then is the problem of the investment bank to then sell this onto the open market, to what we call that making a market for it. So they go out, find other investors. It's called a roadshow, who want to buy the stock and then ultimately make a market to get it trading on exchange. Okay, so what happens in this process is there's a negotiation between the investment bank and the original owners on what is the fair price to buy the stock at. Okay, so for that original underwriting purchase. So in the case of Bumble, it was $43 a share. That's what they negotiated. Okay, that's what the CEO of Bumble, what her staff, and what the investment bank, that is what they came to an agreement on. And this is like one of those scenes in the movie. It's like when they're at the conference room table and they're trying to hammer it out. They both have their team of analysts trying to come up with what a fair value for the company is, but it becomes an adversarial relationship because the investment bank, they want to buy it at the lowest possible price. And the original owners, like the CEO of Bumble, she wants to sell it at the highest possible price. So this is when it then becomes a negotiation. So in the case of Bumble, $43 a share. So the stock, though, it immediately started trading in the 70s and it closed Friday at 75. So I mean, just do the math. That's like an 80% gap up. So money was left on the table. Now, this actually happens a lot. And it's kind of just accepted as normal. So first of all, you couldn't buy the stock at 43. Okay, the investment bank, they bought the stock at 43. They sold it to you in the 70s. So that is part of how the investment bank gets paid. Part is a straight up fee. All right, so they don't work for free. They negotiated a fee with Bumble. I don't know what it is. Could probably dig into the filings and find it, but part is the fee. Another part is that gap. That is part of how they get paid. And this has sort of just been accepted as normal. I would argue, though, companies are going to start asking, why are we leaving this money on the table? And look, I'm not against investment banks making money. And I get it why there would be some underpricing on IPOs because the investment bank is taking risk. like they are taking risk by buying stock, and then now it's on them. It becomes their problem to flip it onto the market and trying to find investors for it. Because look, the investment, like they're paying for the stock with cold hard cash. All right, it's not just out of their own goodness, and they're not pairing up investors. And as an investor comes in, they're going to give the cash to the owner. No, like this is like one shot, one kill. That is how underwriting works, and then it becomes the investment bank's problem to flip it onto the market. So I get why there's some underpricing for them to assume the risk. But some companies, I think, are just going to start asking, why do we even have this middleman in the first place? And we've started to see this with some companies doing what's called a direct offering. So Coinbase, they're talking about doing a direct offering too. That means they cut out the middleman and go straight to the market. So we've sometimes seen this with companies that their corporate finance arm is like a whole army brigade. Like they have just tons of people that they could throw at the problem. But I would suggest that maybe we're going to start seeing smaller companies do this with this trend of decentralized finance coming in. So what is the big so what from all of this? I would argue the big so what from all this is Bumble IPO is a good example on why decentralization of finance and financial services is going to be coming along. Now, I say this fully knowing that if I go back into finance at some point, this could be a trend that works against me. If I want to go into equity capital markets or even debt capital markets, because if you look at decentralized lending platforms, who knows, that might be a game changer too. How I'm trying to position myself then is I want to position myself in a way that could be an area that is more resilient to some of these changes in when it comes to things like cryptocurrency or blockchain, or maybe an area that even does better with these trends coming along. Because I don't see these trends changing. If anything, I see companies more and more asking, why do we have this middleman there? I don't think this trend is going to change. So that's the thinking that I'm doing. I am curious to see what you guys think. Let me know in the comments, and definitely get on my Telegram. We're having a lot of really cool discussions on there. I'll include the link below. Sign up for my Substack. So if you like this, hit subscribe. And as always, thanks for watching. I'm out.